Welcome to the video about investing in growth stocks for beginner stock market investors. In this video, we will explore the basics of growth stocks and provide valuable insights for your investment journey. Before we dive into the specifics, let's understand what growth stocks are. Growth stocks are shares of companies that have demonstrated a consistent and strong growth rate. These companies typically reinvest their profits to fuel further expansion. Investing in growth stocks can offer several benefits. Firstly, they have the potential for significant capital appreciation. Secondly, growth stocks are often associated with innovative companies operating in high-growth industries. This could result in higher returns compared to other investment options. Research is vital when it comes to investing in growth stocks. It is essential to analyze a company's financials, growth prospects, and competitive landscape. Additionally, keeping an eye on market trends and industry developments is crucial. When evaluating growth stocks, there are key factors to consider. These include revenue growth, earnings growth, and potential catalysts for future growth. Let's delve into each of these factors. 1. Revenue growth. One important aspect to consider is the company's ability to generate consistent and substantial revenue growth. This indicates that the company's products or services are in high demand and that it has a competitive edge in its market. For example, let's say you are evaluating a technology company that develops innovative software solutions. If you notice that their revenue has been steadily increasing over the past few years, it indicates strong market demand for their products, which could be an encouraging sign of potential future growth. 2. Earnings growth. Evaluating a company's earnings growth is crucial in determining its profitability and overall financial health. Consistent growth in earnings indicates that the company is generating higher profits over time. For instance, suppose you come across a healthcare company that specializes in developing cutting-edge medical devices. If their earnings have been consistently growing year after year, it demonstrates the company's ability to generate profits and might suggest a bright outlook for future growth. 3. Potential catalysts for future growth. Identifying potential catalysts for future growth is another important factor when evaluating growth stocks. These catalysts can range from new product launches, expansion into new markets, strategic partnerships, or regulatory changes. To illustrate, let's say you are considering investing in an energy company that is involved in renewable energy technologies. If there are upcoming government policies that provide incentives for clean energy companies, it could act as a significant catalyst for the company's growth in the future. It is also important to assess the company's management team, competitive advantage, and overall market conditions. By conducting thorough research and adopting a long-term investment approach, you can effectively manage the risks associated with investing in growth stocks. To wrap up, investing in growth stocks can be a rewarding strategy for stock market investors. However, it is important to do your due diligence, stay informed, and have realistic expectations. Don't forget to subscribe to our channel for more informative videos on stock market investing, and make sure to check out the free stock market investing course at investingeducationwithmrb.com.